right, so banking turmoil, central bank uncertainty, and increasingly a gloomier global economic outlook. Investors trying to navigate a sea of unknowns. It's an environment that had left our next guest feeling cautious coming into 2023. Let's find out what his latest views are. Dennis Gartman is the former editor and publisher of the Gartman Letter and a longtime friend of BNN Bloomberg. Dennis, always nice to see you.
Good to see you, John. Thank you for having me on.
Pleasure as always. And you've navigated lots of market ups and downs. How do you feel about this moment?
I'm a little scared, to be quite honest. One never knows how these things are going to turn out. And I manage only my own money. Plus, I'm the chairman of the University of Akron's endowment. But taking care of my own money, I've gone 80% into 2-year notes and the other 20% into cash. I just don't know where stock prices are going to go. I don't know where the economy is going to go. I think it's going to get weaker, both instances. So I think going to the sidelines and holding 2-year notes makes imminent good sense. Getting paid close to 4% for a guarantee for 2 years is I think common sense and reasonable and reasonably wise. So that's where I'm at. The only other alternative is to own a little bit of gold. I think that makes some sense at this point. Although gold has gotten a little sporty on the upside, getting to over $2,000 per ounce earlier today and backing off from that level. So maybe stepping up to buy it today is probably ill-advised, but buying it if we get back to 1925, 1950 per ounce, that's probably not a bad idea. Owning gold stocks is probably not a bad idea. At least 5 or 10% of your portfolio should be in gold stocks at this point. And you just have to be concerned. These things have a tendency to take several weeks to play out. The Fed and the monetary authorities are doing the right thing as far as I'm concerned, making sure that there's plenty of liquidity. There's some problems that are incumbent here, though, especially with the Credit Suisse UBS circumstance. The Saudi National Bank has lost almost $1.3 billion in a purchase of almost 10% of Credit Suisse, 6 months ago. And it's almost become worthless. So their propensity to step up and offer liquidity and be interested investors in the course of the next several years has been greatly diminished. So these are troublesome times, disconcerting times, confusing times, and I think the sidelines is the best place to be. As I've always said, in a bear market, he or she who loses the least amount of money is the winner, and this is a bear market.
And look, when we think of times, it's been hard not for some people to look at 2008, find similarities. A lot of people will say we're talking about a very different environment. But maybe, Dennis, the question we should be asking is, what is this environment that we're in? An environment where just 2 weeks ago, the story was rates going up to fight inflation. That has an economic toll. But now we also have banking turmoil. It's almost like you've got a stagflation worry on one hand and then financial stability on the other, and you put them all together, and who knows what comes out the other end.
You have confusion, and that's what we have. The question shall be, what will the Fed do? And I think if you'd have asked me 3 weeks ago what the Fed was going to do, I'd have said they're going to move by 50 basis points. The Fed cannot move by 50 basis points this time. They have to take into consideration the problems that are endemic to the banking system, but they have to, at the same time, they have to retain some consistency in their fight against inflation. So the Fed has to go with 25 basis point increase in the overnight Fed funds rate. But we'll listen to what Mr. Powell has to say with a very pointed ears this time in his press conference after the meeting to see what kind of language he uses. And if you'd have asked me 3 weeks ago what the Fed was going to do, I'd say 50, 25, and 25. Now I say 25, 25, and maybe that's the end. Time shall tell.
All right. In terms of the folks who are invested in longer-term bonds in their retirement savings accounts, I mean, you talked about short-term treasuries,
yes.
But it feels like just like Silicon Valley Bank had to grapple with being caught with long-duration fixed income, that's something that a lot of investors are going to have to think about long-term as well.
They're not in exactly the same position, but they're in a very similar position to what happened to Silicon Valley National Bank. That was a banking problem 101 that they completely missed. The asset liability mismatch that they had was astonishing in size. And what bothers me is that nobody's talking about the fact that the Fed has the same asset liability mismatch, and the losses that the Fed would have to mark to market if they were required to mark to market would be awe-inspiring. So there are more banks out there are more individuals out there are more corporations out there who have the same asset liability mismatch that Silicon Valley Bank had. and nobody's talking about it. Nobody, and people should be. It's a problem that's going to be incumbent, and we're going to have to deal with over the course of the next several months. No question about that.
Well, I'm sure at the very least there'll be a little bit of dialogue around that as we march towards that Fed decision this week. Dennis, nice to have you back with us. Appreciate your time as always.
Well, one of Canada's biggest cannabis retailers, High Tide, is cutting back on its long-term growth plans as it eyes positive cash flow. For more, let's hand things over to David George Kosh. David.
Thanks, Jacqueline. I'm joined here with Raj Grover. He's the CEO of High Tide, one of Canada's largest cannabis retailers. Raj, thanks for joining us today.
Thanks for having me, David.
Raj, I want to start with your last quarterly results that you reported late last week. It was your 12th straight quarter of positive adjusted EBITDA, but it seems like a lot of other retailers are having more success crossing that particular financial threshold. Why are retailers in the cannabis space having a better time seeing positive adjusted EBITDA than the producer side of things?
You know, retail is a very different beast, David, than the growing or the producer side of things. Retail is not as complicated as what the growers have to deal with, simply because of the large facilities that they have to build and output that they need to generate. But it's just, as per my knowledge, there's almost 1.5 billion grams of cannabis sitting in producer vaults that they must move. And what I'm hearing is that they're even moving these at negative gross margins. So, fortunately for us, retail is a very different beast. And, as you can see, our track record, we have been delivering positive adjusted EBITDA for 12 straight quarters. And now we have our eyes set on generating free cash flow from our operations.
I wanted to ask this question later on in the interview, but I might as well ask it now, given how you've alluded to all this unsold cannabis, 1.5 billion grams, as you alluded to earlier. There seems to be a significant amount of creditor protection proceedings in the cannabis space right now, both on the retail and the producer side over the past 2 years. How do you expect that to continue shaking out? Do you continue to see more carnage in the industry, or will it be more isolated to a certain part of the sector?
Yeah, David, unfortunately, I don't think that we are done yet. And I think the CCAA proceedings and the bankruptcy proceedings are happening more in line on the production side and a little bit less on for the retail operators. Simply, again, I explained those dynamics that it's very hard to build these facilities and manage these facilities and constantly be on top of cannabis production in a market like Canada, where we have over 700-800 licensed producers. So I don't think that we are out of that painful curve yet. I think that will continue for a year or two. But again, thankfully for us, we are still growing exponentially. And, we have on purpose now turned our focus on free cash flow generation as the macro remains challenging and the cannabis capital markets have further deteriorated. So we are focused on our retail operations, but I think the pain will continue a little bit further for the growers.
Now, Raj, you've disclosed on your last quarterly results that you have plans to really dial back on the amount of growth in the retail footprint of High Tide and instead focus more on positive cash flow. Are you doing this as a sign of just seeing too much saturation in the cannabis retail space?
Yeah, look, consolidation is happening at high levels. It has been happening over the last 2-3 years. There's over 3,000 stores in Canada now. Alberta, which is just 4.3 million population, has over 800 locations. That's a lot for Alberta, and the same thing goes for Ontario. We have approximately 2,000 stores in Ontario and still growing, although not at the same rate. So I think it makes a lot of sense now for the market to further consolidate. And, I believe, David, that the marginal operators will not be renewing their leases, which are coming up here at the 5-year cannabis legalization anniversary coming up in October. We will see a lot of these marginal players not last in the landscape, and some of this revenue will disproportionately come back to larger players like High Tide.
So while you're speaking, we were showing our viewers some of the recent stock performance of High Tide and how High Tide was underperforming Canopy Growth and Tilray over the course of the past year. And that's interesting. We see High Tide generating positive adjusted EBITDA, yet companies like Tilray and Canopy Growth are reporting significant write-downs and steep losses. Where do you see that disconnect happening in the marketplace between your balance sheet and the balance sheet of producers that are generating better valuations?
Look, your guess is as good as mine on this, but I'd like to say that we only came to the public markets at the end of 2018, which was December 2018. A lot of these producers like Canopy and Tilray and others caught on the initial cannabis hype, which gathered them a lot of shareholders. That is not the case for companies such as High Tide, which was a little bit later in the cannabis innings. To say. So, we have not experienced the same type of growth or shareholder growth in our company as the producers have. But this is simply due to the fact that, they were trading in public markets 2 to 3 years prior to us. It's not due to lack of our execution. As you can clearly see, we are actually now the largest revenue generating cannabis company that reports in Canadian dollars in Canada. And, and our market cap is less than 10% than some of the producers that you're naming here. So, that disconnect is for everybody to see. But I think at some point the tables will turn and we will get recognized for our execution.
Raj, thank you very much.
So we got another report released this week by the UN-backed climate scientists at the Intergovernmental Panel on Climate Change. We're joined now by Jessica Green, a professor of climate policy and politics at the University of Toronto, to walk through this. I mean, it's complex research, and they're always very cautious at the IPCC, in my experience. And what were the one or two big messages you think they were trying to get across?
Well, I think their voice has become more definitive over time, saying this is a crisis, and this is we've reached now fever pitch with them. They've said, look, we have to reduce greenhouse gases immediately and quickly, and that every little bit counts because we are facing a climate crisis, which is going to threaten the well-being of populations around the world.
They say that 1.5 degrees of warming above pre-industrial levels, we could get there within 10 years. Now, there's nothing, that's an arbitrary line human beings have created. There's nothing to do with, nature doesn't do that. But why is 1.5 degrees seen as something of a benchmark?
Well, 1.5 degrees is what was agreed to in the Paris Agreement in 2015 when countries said that they would commit to limiting warming to 1.5 degrees C and to becoming essentially net zero as a global population by 2050. So it is a political number, but we know that going over 1.5 would be very bad.
You, as a political researcher, I mean, the panel says we have the technology, we have the physical means. So in many ways, this is a political question. How are we going to do it? Do we want to do it?
Absolutely. This is not primarily a technological problem. It is a political problem.
Although it is a challenge. I mean, we have a society based on fossil fuels right now.
Indeed. There are things that we still need to figure out how to decarbonize, but there are also things that we know how to decarbonize and haven't done completely. So I think it's both things, but the main problem right now is how do we overcome the political obstacles to really putting that technology into play as quickly as possible.
Mark Jacquard, a researcher in Canada, insofar as I understand his work, he has made the point that unless we make it easy for consumers, or at least seamless to convert to a new lifestyle, I mean, just telling people to give up meat, that's just not going to work.
No, I think that we've been thinking about this a lot the wrong way, saying that for consumers, you have to consume less, do less, live smaller. And that's a political loser. What we really need to do is think about, first of all, how to constrain supply. We have to stop pulling fossil fuels out of the ground. And we have to help consumers and people just adjust to that new reality by supporting them through that transition. And that's not something that we've fully thought through yet.
For example, designing communities where you don't need a car.
Correct. We designing cities where public transportation is free so that everybody is incentivized to use it.
And free and pleasant.
Yes,
yeah.
Pleasant would be good as well.
Yeah, that's right. So, of course, we kind of forget cutting these emissions would remove enormous pollutants from the air as well.
Yes. I mean, we know that fossil fuels not only cook the planet, but they are terrible for our lungs. They slow development, and they're responsible for millions of deaths every year. So there are a lot of reasons that we need to stop burning fossil fuels as quickly as possible.
You penned an editorial or an op-ed lately, and you're not happy with some of these carbon offsets. People saying we're planting trees in Mozambique, so could you applaud us?
Yes, I mean, even the Pope is against offsets, so I don't think it's a controversial opinion here. Offsets are really a license to continue business as usual, for us to all feel good about ourselves. We know actually from a lot of political science research and scientific research that they don't produce the emissions often that they promise.
Or though the activity would have been done anyway.
Or the activity
Right.
would have been done anyway. So commodifying the absence of something isn't going to help us decarbonize our society. What we really need to do is direct government investments into renewable energies and all of the societal transformations that we need, like better rail, better transport, and these kinds of things.
Vaclav Simel, the author, he's an academic in Canada, and you've read his work. He says we've got to try to take politics out of the global warming debate and just stick to the scientific facts. But that's a lot to ask of people, isn't it?
Yes, well, as a political scientist, of course, I would say that we need to put the politics in it. And the reality is that there are people and industries that don't want us to decarbonize. And, Canada has to face facts that we are the fourth largest oil and gas exporter in the world, in a world that has no future for fossil fuels. So we need to figure out what to do about that very quickly.
No future. So we just touch on natural gas. As you know, it's being billed as the bridge, as the transition.
Yes, natural gas has been sold to all of us as the bridge fuel. The problem is what happens is we build this huge infrastructure for natural gas, as we are wont to do here in Canada. And then because we've built it and had these huge investments, we're stuck with it for 50 or 100 years. And we don't have 50 or 100 years to continue burning fossil fuels.
We'll have to jump. Thank you very much for coming in.
Thank you.
Jessica Green is Professor of Climate Policy and Politics at the University of Toronto.
The parent company of Olive Garden, Darden Restaurants, topped expectations for both profit and sales in its most recent quarter. Shares were a bit up and down today, but over the last year, they've gained almost 15%. About 12% there. Our next guest covers the restaurant industry and Darden and is the only analyst with a sell on the stock. Let's bring in Sean Dunlop, equity analyst for Morningstar. Sean, thanks so much for joining us today.
Thanks for having me.
So you've got a sell rating. However, you did outline, the high points for the quarter here for the company. So can you walk us through what went well?
Yeah, I would say by and large a really good quarter for Darden. So they outperformed industry traffic benchmarks by about 700 basis points, 7%. Actually saw a positive 4% against a 3% decline industry-wide. I would say the big narrative was actually restaurant margin recapture. So on a sequential basis, we saw Darden add 340 basis points of restaurant margin. So they're actually coming out a little bit ahead of where they were pre-COVID. And that's against a backdrop where across the industry, the restaurants that we cover are running about 400 basis points behind. So as you sort of look at what that means for the next couple of quarters, sort of into fiscal 2024, we think that really validates management's 2.5% to 3% unit growth target. Obviously, we came away from the quarter very optimistic and plan to raise our own fair value estimate by about 15%.
So how has Darden been able to do that on margins when, you mentioned the industry standard, they're doing better?
They are, yeah. And I think part of that is they've got, within full service, they've got some restaurants whose value proposition resonates very well in this environment where maybe you've got consumers trading down into some of those Darden restaurants. They've underpriced inflation, so they took 6.3% annual pricing. That's against 7% inflation during the quarter. And so consumers are starting to notice that, and they're starting to gravitate towards those restaurants where they feel like they're getting maybe a little bit better value for the money. And then with Darden, they've also taken really a scalpel to costs, both in the back office side, but also in the marketing side. So you see about a third of the marketing expense that we saw pre-COVID, with obviously much higher return on advertising spend. And maybe the more important point is that management suggested that they're planning to sort of keep that low, even as the industry moves into a more promotional environment.
Yeah, that idea of underpricing inflation doesn't really seem like one that would, equal better margins, though.
That's absolutely right. And, we were very bearish on the name for, call it the last 6 quarters for that reason. And even as you look across the rest of the industry, like Domino's has tried that and they found themselves in a very different place in a way where we think, Domino's long-term restaurant level margins are probably going to be structurally lower than they were pre-COVID. For whatever reason, Darden's been able to attract traffic in a way that their QSR competitors have not. I think part of that may be just that their comp set is a little bit softer in that full service industry, and that was where we saw some of the targeted closures during COVID. So maybe that's part of the equation, but on balance, very impressed with what management has been able to do.
Would you have rather seen them, I don't want to say take advantage, because that's not what it would be, but just to sort of keep up with inflation when it comes to those price increases, when you're thinking ingredients, everything across the board, where all those pressures have been coming from, would that have been a strategy you would have preferred to see them do?
Certainly, if you asked me a quarter or two ago, in the fiscal second quarter, they posted 16.6% restaurant level margins, and it looked like it was going to be a very difficult journey to sort of recapture the pre-pandemic profitability levels. Obviously, we're in a very different place today. That's why our reaction is what it is today. But in general, yeah, I mean, we've seen commodity costs are up in the high 20s relative to February 2020. Labor costs are up in the neighborhood of 22%. And so it seems like aggressively pricing into that would be a cogent strategy, but they've really been able to make it up on volume and marketing leverage.
So you've raised your expectations for the company, but you still have a sell rating on it?
Yeah, I mean, it's about the environment that we're in, of course, right? Yeah, the way I look at it is that from a macro perspective, consumers are spending more than they usually do in restaurants. In the United States, about 7.7% of disposable income, which is about 80 basis points or 10% hot. And so as we move into 2023 and you see an environment where consumers' savings rates have declined, where they're using more revolving credit, and this you see this more qualified, more cautious consumer, I do think it's natural that we would see a migration towards cheaper channels if you think about grocery or C-stores. And so as you look at what that means for the restaurant space, I think that suggests a year of really sluggish comparable store sales growth and difficulty generating incremental margin recapture from here.
And that's why you see a chain like Domino's doing better in that kind of environment.
Definitely, yeah. Consumers typically trade out of full service into quick service, which it was something that management was keen to highlight that they hadn't seen yet. But even from quick service, a restaurant like Domino's, you'll see consumers trade towards, grocery store pizza or towards a C-store. So that's sort of what we're keeping an eye on, and we do expect to see some of that as we go into maybe a more recessionary environment.
Okay, and tell us about Wendy's as well, because you also like Wendy's.
I do, yeah. So, I mean, I guess maybe to be more fair with Domino's, we do have a buy rating on the stock. We do think that pizza categorically outperforms during a recessionary environment. So even with the pressure that we've seen in the delivery business, we think the market is maybe over-discounting pressure. The brand has the best unit economics of any chain that we cover. So that sort of unit development narrative is safe. Wendy's is in a little bit of a different spot, but we think that having strung together more than 10 years of U.S. comparable store sales growth consecutively, relatively competitive restaurant level margins, and then some of the strides that the firm is starting to make on the digital and technology initiatives, as well as a handful of development agreements that it's signed in the Asia Pacific, it creates a rosier picture than maybe is priced into markets.
Now, this isn't one that we were going to touch on, but when you're thinking Wendy's, I think burgers and whatnot, and I'm thinking McDonald's as well, or even KFC has been out there with its chicken burger lately, trying to grab the attention away from McDonald's. But just the sort of fast food space in general, do you see potential in those other companies as well?
Yeah, it's interesting. The sensitivity is not as heightened, as pronounced as people seem to think. So we typically see a 3.5% to 4.5% drawdown in comparable store sales during a recession. I hate to throw out the hard R word. But a lot of these brands, because of their relative, we'll say, inoculation to some of these cyclical trends, and because of relatively attractive dividends, markets have priced accordingly. So you're still seeing sort of high 20s PE multiples in this environment. And so as we expect sales to be a little bit more difficult to come by, I think it's a little bit tougher to raise prices on consumers in this current environment going into 2023. I still think a lot of the earnings expectations that are baked into current prices are maybe a little bit aggressive for full year 23 and maybe into 2024. So as those start to come down, it's possible that investors see buying opportunity, but we still have the sector trading at about a 4 to 5% premium to our fair valuations.
Sean, great to get your analysis today. We appreciate it.
Many investors, of course, are looking for ways to position their portfolios in rising rate inflationary environments. Our next guest says one option is real estate-based private debt. We're joined now, by Dean Kirkham, President and Chief Operating Officer at Trez Capital. Thanks a lot for joining us. Let's start with a simple explanation of what private debt is, and I assume this is opposed to publicly traded debt.
Yeah, no, thanks, Paul, and it's great to be here this morning. Trez Capital, we provide a traditional fixed income alternative in real estate private debt specifically. Trez Capital has been providing real estate mortgages to developers in both Canada and in the U.S. for over 25 years. Again, as an alternative to traditional bank financing, typically a little bit higher leverage, facilitating investment or facilitating development in both of those markets
And you also sell this debt to investors, is that correct?
That's correct. Again, we sell both in the retail channel and as well as to the institutional investor as well. And again, what we see certainly in the last decade, increasingly strong appetite from both the retail investor, the retail PM, the institutional investor as well, in interest in private debt and really choosing private debt as a fixed income alternative, or really an increasingly dominant sleeve within their fixed income portfolio. Really for good reason. It's been offering portfolio diversity, low correlation to the equity markets and other traditional asset classes. And in the case of Trez Capital, we offer floating rate product. And so as a result, over the last year, we've been able to capture the increase in interest rates on their way up. As interest rates have been going up, I think investors need to understand that there is a relative illiquidity in the private debt market, in particular real estate private debt. But for those with long-term investment horizons, certainly institutional investor that understands that, you can get typically higher rates or higher returns in the traditional investment grade fixed income product, and commensurate with really high yield bond returns, but arguably lower volatility and better downside protection. That's specific to real estate. We get particularly stable returns and given the underlying collateral. Paul.
A lot of this is related to floating rate debt, where interest rates payable on the debt increase when a central bank raises interest rates, correct?
That's correct. Again, you look back in the last year, and Trez Capital and other products like us have really benefited from the rise in interest rate. So you look back over the last year with the rise in interest rate. In particular, given the fact that in real estate we've seen strong run up in rents, particularly in the residential space, strong run up in rent, strong run up in values. A lot of people are asking, what about the risk of the product? We've had strong run up in values over the last 2 to 3 years, and as a result, I know that when we look at our portfolio, even given the increase in interest rate in the current environment, we've got an exceptionally strong performance as we go into 2023.
What has history shown us about these products, floating rate debt in particular, and periods of rising interest rates as central banks try to deal with inflation?
Yeah, so first of all, they tend to outperform traditional fixed income. Again, as I said, more returns are more commensurate with high yield bonds, but with underlying collateral security that you would get in real estate with real estate collateral. So again, we've had strong, stable returns. I know at Trez Capital that never had a down year in our 25-year history, and so the product offers strong and stable returns over the long run. In the last year, as an example, we were kind of a lone bright spot. Products like ourselves in the market. And again, that's continues to drive investment into our product for sure.
One feature of public markets, of course, is liquidity, where an investor can sell or buy at almost any instant. You've mentioned the traditional lack of liquidity, or certainly much reduced liquidity in private debt markets. That tends to be a feature of private markets generally. What do investors need to understand about the reduced liquidity in these markets?
Yes, I mean, they need to understand exactly that. I mean, again, there's sort of the traditional, there's the mismatch again when you're investing in products like real estate. In the case of Trez Capital, we're invested in short duration product or short duration development, but your money, your capital is really tied up for 2 to 3 years. And as a result, it results in lower liquidity. Now, as a result, there's often higher returns as a result. So one needs to definitely understand the lack of liquidity in that product as an alternative.
We spoke to a chief investment officer a short time ago in this program, and he, in this environment, likes real estate investment trusts that are oriented towards residential real estate, the likes of Cap REIT and Minto REIT and InterRent. Is part of this story, the private real estate debt story, is it anchored somewhat in the view that there is and will be strong demand for residential real estate in Canada?
You know, for the last 5 to 7 years, Trez Capital is focused on real estate. Again, if you look at it dominates our portfolio. And, you look at, asset classes like office, where I think we see greater risk, and again, in particular in the current environment with some of the work from home movement. And so certainly a lot of risk there. But certainly for us, we had a lot of focus. We continue to believe there's a lot of merits in residential real estate. You look at both Canada and the U.S., we've had a tremendous undersupply of housing that dates back for decades. I mean, it was reported yesterday, I think we're sitting under 2% vacancy in Canada. And at the same time, we reported we get 1 million new entrants into Canada last year. And so the government has certainly announced that they'd like to continue to push for strong immigration, and we need it over the coming decade. And again, so 400,000 to 500,000 new entrants, new immigrants a year is going to continue to feed that. Could feed demand for housing. The same thing goes in the U.S. About 80% of our portfolio is in the U.S., and particularly the Sun Belt states. It's a similar story. The U.S. has actually suffered for the same kind of issues, a strong undersupply of housing that's been lasting, that really dates back to the Great Financial Recession. And at the same time, we've had an incredible, they're calling it the Great Migration south in the U.S. To states like Texas, Florida, the Carolinas, and Arizona. It's not just people seeking, it's just not sun seekers seeking the warmth. These are the states with, traditionally low income taxes, low barriers to entry, really pro-business environments that are attracting the Fortune 500 companies to migrate south. So you got places like New York, as an example, losing 1 million people over the last decade. Well, the benefactors of that are places like Dallas, Texas, Dallas-Fort Worth. Would be the same thing as going with Sarasota, Tampa, Miami, Palm Beach, and they're receiving skilled workers coming into the market and demanding with high demands for housing. And so with that as a backdrop, we continue to believe that there's a lot of opportunity in residential, both in the investment side and on the debt side going forward.
Dean Kirkham, thank you a great deal for this conversation. He's President and Chief Operating Officer at Trez Capital.